Question 1. Assessment of how an Australian general insurance company could strategically incorporate the increasing prevalence and severity of environmental risks, such as bushfires and floods, into its core business operations and risk management framework to ensure long-term viability and regulatory compliance. Option A. Delegate the responsibility for managing environmental risks to external government agencies and disaster relief organizations. Option B. Treat environmental risks as purely external factors and rely on historical data for pricing, assuming government relief will cover significant losses. Option C. Proactively integrate environmental risk assessment and mitigation strategies into the enterprise risk management framework, including product development, underwriting, and claims management. Option D. Exclusively focus on historical claims data and ignore the potential for increased frequency and severity of environmental events due to climate change. Correct answer is C. Proactively integrate environmental risk assessment and mitigation strategies into the enterprise risk management framework, including product development, underwriting, and claims management. Explanation. Scenario analysis. This scenario presents a professional challenge for an insurance business operating within the Australian regulatory framework, specifically concerning the Anziif Foundation Certificate in Insurance Business Fundamentals for General Insurance, JIB 41-15 exam. The challenge lies in accurately assessing and managing the growing impact of environmental risks, such as climate change and natural disasters, on insurance products and operations. This requires a nuanced understanding of how these risks can affect underwriting, pricing, claims, and solvency, all while adhering to regulatory expectations for responsible risk management and consumer protection. The dynamic nature of environmental risks means that traditional actuarial models may need adaptation, and insurers must demonstrate foresight and resilience. Correct approach analysis. The correct approach involves proactively integrating environmental risk considerations into the insurer's enterprise risk management framework. This means systematically identifying, assessing, and mitigating the potential impacts of environmental hazards on the business. This aligns with the principles of sound financial management and prudential supervision expected of Australian insurers. Regulatory bodies like APRA, Australian Prudential Regulation Authority, while not explicitly detailed in the JIB 41-15 syllabus, emphasize the importance of robust risk management practices, which inherently include emerging risks like environmental factors. By embedding these considerations into the insurer can ensure that its capital adequacy, pricing strategies, and product offerings remain sustainable and compliant with the overarching goal of protecting policyholders and maintaining financial stability. This proactive stance also supports the ethical obligation to provide fair and appropriate insurance coverage in the face of evolving risks. Incorrect approaches analysis. Ignoring environmental risks or treating them as purely external factors beyond the insurer's control represents a significant regulatory and ethical failure. This approach neglects the fundamental responsibility of an insurer to understand and manage the risks it underwrites. It could lead to underpricing of policies, inadequate reserving for future claims, and ultimately, financial distress, which would contravene APRA prudential standards and Australian Securities and Investments Commission consumer protection mandates. Focusing solely on historical claims data without accounting for the escalating frequency and severity of environmental events is another flawed approach. This is a failure to adapt to changing risk landscapes, which is a core expectation for responsible insurance operations. It risks misrepresenting the true cost of insurance and failing to adequately prepare for future claims, potentially leading to an inability to meet policyholder obligations. Relying exclusively on government disaster relief programs to offset insurance losses is also an unacceptable approach. While government support exists, it is not a substitute for an insurer's own risk management and financial planning. This approach outsources a core responsibility of the insurer and could lead to a misrepresentation of the insurer's financial resilience and its capacity to fulfill its contractual obligations to policyholders. Professional reasoning. Professionals in the insurance industry must adopt a forward-looking and integrated approach to risk management. This involves a continuous process of identifying emerging risks, assessing their potential impact, and developing strategies to mitigate them. When faced with complex and evolving risks like environmental factors, professionals should 1. Understand the regulatory expectations for risk management and solvency. 2. Systematically identify all relevant risks, including those that are not immediately apparent or historically significant. 3. Quantify the potential impact of these risks on the business, considering both financial and operational aspects. 4. Develop and implement mitigation strategies, which may include product adjustments, underwriting changes, or capital management. 5. Regularly review and update risk assessments and mitigation plans to reflect changes in the risk environment. This structured approach ensures that the business remains resilient, compliant, and capable of meeting its obligations to policyholders. Question 2. Upon reviewing a potential client's application for commercial property insurance, an insurance broker identifies several potential risk factors that the client has either not fully disclosed or has presented in a way that minimizes their significance. The client is keen to secure the lowest possible premium. Which of the following represents the most appropriate approach for the broker in this situation? Option A. Inform the client that the identified risks are minor and not worth mentioning to the insurer, as it will likely increase the cost of insurance. Option B. Proceed with the application using the information provided by the client, assuming the client has accurately represented the risk, and focus on securing the most competitive premium. Option C. Downplay the significance of the identified risk factors when presenting the proposal to insurers to help the client obtain a more favorable premium. Option D. Advise the client on the importance of full disclosure of all material facts to the insurer and assist them in accurately documenting these risks, even if it means a higher premium. The correct answer is D. Advise the client on the importance of full disclosure of all material facts to the insurer and assist them in accurately documenting these risks, even if it means a higher premium. Explanation. This scenario presents a professional challenge because an insurance broker, acting as an intermediary, has a dual responsibility: to the client to secure appropriate cover and to the insurer to provide accurate risk information. Misrepresenting or failing to fully disclose material facts during the risk assessment phase can lead to significant consequences, including policy voidance, claims disputes, and reputational damage for both the broker and the insurer. The broker's role in risk assessment is critical for ensuring the insurer can accurately price the risk and underwrite the policy appropriately. The correct approach involves the broker diligently gathering all relevant information from the client, verifying its accuracy where possible, and then presenting a complete and truthful picture of the risk to potential insurers. This aligns with the fundamental principles of utmost good faith, uberrimi fidei, that govern insurance contracts. Specifically, under Australian insurance law, particularly the Insurance Contracts Act 1984 CTH, clients have a duty to disclose all material facts, and brokers have a responsibility to assist clients in meeting this duty and to ensure that the information provided to insurers is accurate. Failing to do so can breach these duties. An incorrect approach of downplaying or omitting known material facts to secure a more favorable premium for the client is ethically and regulatorily unsound. This breaches the duty of utmost good faith owed to the insurer and can lead to the insurer being misled about the true nature of the risk. Such conduct could result in the insurer avoiding liability for a claim if the non-disclosure or misrepresentation is discovered, leaving the client uninsured and potentially exposing the broker to professional negligence claims and disciplinary action from regulatory bodies like the Australian Securities and Investments Commission. Another incorrect approach of relying solely on the client's potentially incomplete or inaccurate statements without further inquiry or verification, especially when the broker has reason to believe there might be undisclosed risks, also falls short. While the primary duty of disclosure rests with the client, a competent broker is expected to exercise reasonable skill and care in assisting the client and in their dealings with insurers. This includes asking probing questions and seeking clarification on ambiguous information. The professional decision-making process in such situations requires a broker to prioritize transparency and accuracy. They should adopt a proactive stance in risk assessment, asking comprehensive questions, documenting all discussions, and clearly explaining the client's duty of disclosure. If there is any doubt about the materiality of a fact or the accuracy of information provided, the broker should err on the side of disclosure to the insurer. This approach safeguards the client's interests by ensuring appropriate cover is obtained and protects the integrity of the insurance market by upholding the principles of good faith and accurate risk assessment. Question 3. The efficiency study reveals that a proposed new insurance product offers a lump sum payment to the beneficiary upon the death of the insured individual. This product is intended to provide financial support to the deceased's family. Which of the following classifications best describes this product within the Australian regulatory framework for insurance? Option A, ancillary insurance. Option B, life insurance. Option C, general insurance. Option D, health insurance. The correct answer is B, life insurance. Explanation. This scenario presents a professional challenge because it requires distinguishing between different types of insurance products and their regulatory classifications, which is fundamental to understanding the scope of general insurance business as covered by the Anziif Foundation Certificate in Insurance Business Fundamentals for General Insurance JIB 41-15 exam. Misclassifying a product can lead to regulatory breaches, incorrect product offerings, and potential consumer detriment. Careful judgment is required to ensure compliance with Australian regulations governing the insurance industry. The correct approach involves accurately identifying that a policy covering a person's life, including death or survival, falls under life insurance, which is distinct from general insurance. General insurance, as defined by Australian legislation and regulatory guidance relevant to this exam, typically covers assets, liabilities, and events other than death or bodily injury. Therefore, a policy that provides a payout upon the death of the insured is unequivocally a life insurance product. This aligns with the regulatory framework that separates the oversight and licensing requirements for life insurers from those of general insurers. An incorrect approach would be to classify a life insurance policy as general insurance. This failure stems from a misunderstanding of the core definitions and regulatory boundaries. Australian law, such as the Insurance Contracts Act 1984, CTH, and prudential standards set by the Australian Prudential Regulation Authority, APRA, clearly delineates between life insurance business and general insurance business. Treating a life policy as general insurance would violate these regulatory distinctions, potentially leading to offering products without the appropriate licensing, failing to meet specific capital requirements for life insurers, and not adhering to consumer protection measures tailored for life insurance. Another incorrect approach would be to consider a health insurance policy as a type of life insurance. While health insurance deals with the well-being of an individual, its primary focus is on medical expenses and treatment, not on providing a benefit upon death or survival over a long term, which are the hallmarks of life insurance. Health insurance in Australia is often regulated under specific provisions, sometimes within the broader general insurance framework or through dedicated health insurance legislation, but it is not classified as life insurance. Misclassifying health insurance would lead to the application of incorrect regulatory requirements and potentially misinformed product development and sales practices. The professional decision-making process for similar situations should involve a systematic review of product features against established definitions and regulatory classifications. This includes consulting relevant legislation, regulatory guidance, and industry standards. When in doubt, seeking clarification from compliance officers or legal counsel is a prudent step. The focus must always be on accurate classification to ensure regulatory compliance, ethical conduct, and the provision of appropriate products to consumers. Question 4. Performance analysis shows a recurring pattern where claims assessors, upon discovering potential non-disclosure of pre-existing conditions by an insured, immediately seek to deny the claim without a thorough review of the policy terms or the specific provisions of the Insurance Contracts Act 1984, CTH, regarding disclosure and remedies. Which of the following approaches best aligns with the regulatory framework and best practice for handling such situations? Option A. The claims assessor should accept the claim at face value and process it without any further inquiry, despite the suspicion of non-disclosure, to maintain customer goodwill. Option B. The claims assessor should thoroughly review the policy wording and the Insurance Contracts Act 1984, CTH, to understand the insured's duty of disclosure and the insurer's available remedies, and then proceed with a fair and documented investigation into the alleged non-disclosure, considering any prejudice to the insurer. Option C. The claims assessor should immediately reject the claim, citing non-disclosure of pre-existing conditions as the sole reason for denial, without further investigation or consultation. Option D. The claims assessor should inform the insured that their policy is void due to non-disclosure and that the claim will not be paid, without providing specific details or an opportunity for the insured to respond. The correct answer is B. The claims assessor should thoroughly review the policy wording and the Insurance Contracts Act 1984, CTH, to understand the insured's duty of disclosure and the insurer's available remedies, and then proceed with a fair and documented investigation into the alleged non-disclosure, considering any prejudice to the insurer. Explanation: this scenario presents a professional challenge due to the potential for misinterpreting and misapplying the Insurance Contracts Act 1984, CTH, in a practical business context. The core difficulty lies in balancing the insurer's need for accurate information with the insured's duty of disclosure and the insurer's obligations under the Act. Careful judgment is required to ensure compliance while maintaining fair treatment of the customer. The correct approach involves the insurer's claims assessor diligently reviewing the policy wording and relevant sections of the Insurance Contracts Act 1984, CTH, specifically focusing on the duty of disclosure and the insurer's remedies for non-disclosure or misrepresentation. This approach is correct because it directly addresses the legal requirements governing the insurer's actions in handling a claim where potential non-disclosure is identified. The Act mandates that insurers must act reasonably and fairly, and that remedies for non-disclosure are subject to specific conditions, such as the insurer proving that had they known the true facts, they would not have entered into the contract or would have done so on different terms. This approach prioritizes legal compliance and a fair assessment process. An incorrect approach that involves immediately rejecting the claim based solely on the suspicion of non-disclosure fails to adhere to the procedural requirements and protections afforded to the insured under the Insurance Contracts Act 1984, CTH. This failure constitutes a breach of the Act's provisions regarding remedies for non-disclosure, which typically require the insurer to demonstrate prejudice or that the non-disclosure was fraudulent. Another incorrect approach, which is to accept the claim without further investigation despite the suspicion, ignores the insurer's right to accurate information and potentially exposes the insurer to undue risk, which, while not a direct breach of the Act in this instance, is poor risk management and could lead to future compliance issues if a pattern emerges. A third incorrect approach, which is to inform the insured that their policy is void due to non-disclosure without providing specific details or allowing them to respond, also fails to meet the Act's requirements for fair dealing and due process. Professionals should employ a decision-making framework that prioritizes understanding the specific legal obligations under the Insurance Contracts Act 1984, CTH. This involves 1. Identifying the relevant legal provisions e.g., duty of disclosure, insurer's remedies. 2. Gathering all necessary facts and evidence related to the claim and the potential non-disclosure. 3. Assessing the impact of the non-disclosure against the policy terms and the Act's requirements. 4. Communicating clearly and fairly with the insured, providing them with an opportunity to respond to any allegations. 5. Documenting all decisions and the rationale behind them, ensuring a clear audit trail. Question 5. Implementation of a new competitor entering the general insurance market in Australia, offering innovative products at competitive prices, presents a significant challenge for an established insurer. The insurer's risk management team is debating how to classify this emerging threat. Which of the following classifications best describes the primary nature of this risk from the insurer's perspective, considering its potential impact on profitability and market position? Option A, a speculative risk. Option B, a static risk. Option C, a dynamic risk. Option D, a pure risk. The correct answer is A, a speculative risk. Explanation: this scenario is professionally challenging because it requires the insurance professional to accurately classify risks to ensure appropriate underwriting, pricing, and product development, all within the Australian regulatory framework for general insurance. Misclassification can lead to significant financial losses for the insurer, inadequate protection for the policyholder, and potential breaches of regulatory obligations. Careful judgment is required to distinguish between risks that are inherent to the business and those that arise from external changes, and between risks that offer a potential for gain and those that only present a possibility of loss. The correct approach involves identifying the risk of a new competitor entering the market as a speculative risk. This is because it presents an opportunity for both potential profit, e.g., by capturing market share or developing innovative products to counter the competition and potential loss, e.g., through reduced market share or price wars. Speculative risks are those where there is a possibility of gain as well as loss, and they are generally not insurable in the traditional sense, as insurers typically cover pure risks. The regulatory framework in Australia, as overseen by bodies like APRA, emphasizes sound risk management practices, which includes understanding the nature of risks faced by an insurer. While not directly legislating the classification of speculative risks for underwriting purposes, the principles of prudent financial management and solvency require insurers to accurately assess and manage all forms of risk, including those that are speculative, to ensure long-term viability. An incorrect approach would be to classify the risk of a new competitor entering the market as a pure risk. This is incorrect because pure risks, by definition, only involve the possibility of loss or no loss, not gain. For example, a fire in a warehouse is a pure risk. It can result in a loss or no loss, but never a gain. Classifying a speculative risk as pure would lead to an incorrect assessment of its potential impact and an inappropriate approach to management, potentially leading to the insurer attempting to insure or price for a risk that is not insurable in the traditional sense, or failing to develop strategies to capitalize on potential opportunities or mitigate potential losses arising from competitive pressures. Another incorrect approach would be to classify the risk of a new competitor entering the market as a static risk. This is incorrect because static risks are those that remain relatively constant over time and are not influenced by changes in the economy or society. The entry of a new competitor is a dynamic event, driven by economic factors, market opportunities, and strategic decisions, and it inherently changes the competitive landscape. Static risks are typically associated with the physical environment or human error. Misclassifying a dynamic risk as static would lead to a failure to adapt strategies and underwriting approaches to evolving market conditions, potentially resulting in outdated pricing and inadequate risk mitigation measures. A further incorrect approach would be to classify the risk of a new competitor entering the market as a dynamic risk without further qualification. While the entry of a competitor is indeed a dynamic event, the critical distinction for insurance purposes lies in whether the risk is pure or speculative. Classifying it solely as dynamic without addressing the speculative nature misses the core characteristic that distinguishes it from insurable pure risks. Dynamic risks can be either pure or speculative. For instance, a change in legislation dynamic could lead to a pure risk, e.g., increased compliance costs, or a speculative risk, e.g., a new market opportunity created by the legislation. In this case, the primary characteristic that differentiates it from an insurable risk is its speculative nature. The professional decision-making process for similar situations should involve a systematic risk identification and classification process. This begins with understanding the fundamental definitions of different risk types: pure vs. speculative and static vs. dynamic. The professional must then analyze the specific event or circumstance, considering whether it presents only the possibility of loss, pure, or the possibility of both gain and loss, speculative. Simultaneously, they must assess whether the risk is relatively constant, static, or subject to change due to external factors like economic shifts or technological advancements, dynamic. This analytical approach, grounded in the principles of risk management and aligned with the regulatory expectations for prudent operation within the Australian insurance industry, ensures that risks are appropriately understood and managed. Question 6. Which approach would be most appropriate for an insurance claims assessor in Australia to determine if a loss is covered under a general insurance policy when multiple events contributed to the damage? Option A. Rely on industry averages for similar types of losses to estimate the proximate cause without a specific investigation into the unique circumstances of the claim. Option B. Focus on the immediate event that directly preceded the loss, assuming it is the proximate cause. Option C. Conduct a detailed investigation to identify the dominant and effective cause of the loss, considering the sequence of events and the policy's terms and conditions. Option D. Attribute the loss to the insured's actions if they were involved in any way in the events leading up to the damage, regardless of the direct causal link. The correct answer is B. Focus on the immediate event that directly preceded the loss, assuming it is the proximate cause. Explanation. This scenario is professionally challenging because determining proximate cause requires a nuanced understanding of the chain of events and the policy's terms and conditions, rather than a simple identification of the immediate event. Professionals must avoid making assumptions and instead apply a systematic, legally sound methodology. The correct approach involves a thorough investigation to identify the dominant or efficient cause of the loss, considering the policy's wording and relevant Australian insurance law. This approach aligns with the legal principles of proximate cause as understood in Australian general insurance, which seeks the effective cause that set in motion the chain of events leading to the loss, without which the loss would not have occurred. This requires careful consideration of whether intervening events were foreseeable or broke the chain of causation. An incorrect approach would be to solely focus on the last event before the loss occurred. This fails to acknowledge that the proximate cause might be an earlier event that initiated the sequence. This approach risks misinterpreting the policy coverage and potentially denying a valid claim based on an incomplete causal analysis, which would be contrary to the principles of fair dealing and good faith expected of insurers under Australian law. Another incorrect approach would be to attribute the loss to the insured's actions without a clear causal link established by the policy terms. While an insured's actions can be relevant, they only negate coverage if they are the proximate cause of the loss and fall within an exclusion or are a breach of a condition precedent. Simply being involved in the events leading to the loss does not automatically mean their actions were the proximate cause. This approach could lead to unfair claim denials and breaches of regulatory obligations. Professionals should employ a decision-making framework that prioritizes a comprehensive factual investigation, followed by a rigorous application of the proximate cause test as established by Australian case law and regulatory guidance. This involves identifying all potential causes, assessing their sequence and influence, and determining which cause was the dominant and effective one, in line with the policy's terms and the legal definition of proximate cause. Question 7. The analysis reveals that an underwriter is presented with a proposal for a commercial property insurance policy for a business involved in the specialized manufacturing of rare artisanal cheeses. The proposed sum insured is significantly higher than typical for similar businesses, and the operational processes involve unique, potentially volatile fermentation techniques. The underwriter's standard authority level typically covers risks with a sum insured up to $2 million in standard manufacturing operations. This proposal exceeds the sum insured and presents a non-standard risk profile. Which of the following approaches best demonstrates adherence to underwriting guidelines and authority levels within the Australian regulatory framework for general insurance? Option A. Approve the policy but document it as a standard manufacturing risk to avoid the complexities of seeking additional authority. Option B. Refer the proposal to a senior underwriter or a specialist risk assessor for review and approval, as it falls outside the underwriter's delegated authority and standard guidelines. Option C. Decline the policy immediately due to the deviation from standard risk parameters and sum insured limits. Option D. Approve the policy within the underwriter's existing authority, adjusting the premium to reflect the perceived higher risk without seeking further approval. The correct answer is D. Approve the policy within the underwriter's existing authority, adjusting the premium to reflect the perceived higher risk without seeking further approval. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for efficient processing with the fundamental duty to accurately assess risk and adhere to underwriting authority limits. Misjudging the complexity of the risk or overstepping authority can lead to financial losses for the insurer and potential regulatory breaches. Careful judgment is required to determine when a risk falls outside standard guidelines and necessitates escalation or referral. The correct approach involves recognizing that the proposed policy deviates significantly from standard underwriting guidelines due to the unusual nature of the business operations and the high value of the insured property. This deviation triggers the need to seek approval from a higher authority or a specialist underwriter, as per the insurer's internal underwriting manual and the principles of sound risk management mandated by the Australian regulatory framework for general insurance. This ensures that risks are assessed by individuals with the appropriate expertise and delegated authority, thereby maintaining the insurer's solvency and protecting policyholders. Adhering to established authority levels is a core principle of good governance and risk control within an insurance organization, as outlined in regulatory guidance concerning prudential standards. An incorrect approach would be to approve the policy without seeking further authority, despite the unusual risk factors. This failure to adhere to underwriting guidelines and authority levels constitutes a breach of internal controls and potentially a failure to adequately assess risk, which could expose the insurer to unforeseen losses. This contravenes the regulatory expectation for insurers to maintain robust risk management frameworks. Another incorrect approach would be to reject the policy outright without proper consideration or consultation, simply because it falls outside standard parameters. While caution is necessary, a blanket rejection without exploring potential mitigation strategies or seeking specialist advice may lead to lost business and does not demonstrate a proactive approach to risk assessment. This could be seen as a failure to exercise due diligence in underwriting. A further incorrect approach would be to approve the policy, but misclassify the risk to fit within existing authority levels. This is a form of misrepresentation and a deliberate circumvention of internal controls and regulatory oversight. It undermines the integrity of the underwriting process and exposes the insurer to significant financial and reputational risk. A professional decision-making process for similar situations should involve a systematic review of the proposed risk against established underwriting guidelines. If the risk deviates, the underwriter must assess the nature and extent of the deviation. This assessment should then inform whether the risk can be accepted within their delegated authority, requires referral to a more senior underwriter or specialist, or should be declined. Transparency and adherence to internal procedures and regulatory requirements are paramount throughout this process. Question 8. Operational review demonstrates that a recent motor vehicle insurance claim has been lodged following a single vehicle accident. The claimant states they swerved to avoid a kangaroo. However, preliminary information from a witness suggests the vehicle was traveling at excessive speed. The claims assessor has received the claimant's initial statement and the witness statement. What is the most appropriate next step for the claims assessor to take in managing this claim? Option A. Immediately approve the claim based on the claimant's statement to ensure prompt settlement. Option B. Advise the claimant that the claim is being put on hold indefinitely pending further, unspecified investigations. Option C. Conduct a thorough investigation, gathering all relevant evidence, including vehicle damage reports, road conditions, and any available CCTV footage before making an assessment. Option D. Deny the claim outright due to the conflicting information from the witness. Correct answer is A. Immediately approve the claim based on the claimant's statement to ensure prompt settlement. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's need for accurate information with the claimant's right to fair and timely treatment. The claims assessor must navigate potential conflicts of interest and ensure that the investigation process is conducted ethically and in accordance with regulatory requirements, specifically those relevant to the Australian general insurance market as governed by the Australian Securities and Investments Commission, ASIC, and relevant industry codes of conduct. The correct approach involves a thorough and objective investigation, gathering all necessary information without undue delay, and communicating transparently with the claimant. This aligns with the principles of good faith and fair dealing expected of insurers under Australian law, including the Insurance Contracts Act 1984, CTH, and ASIC Regulatory Guide 65, Consumer Protection in General Insurance. It ensures that the assessment is based on facts and that the settlement, if approved, is fair and reflects the terms of the policy. An incorrect approach of immediately denying the claim based on a single piece of potentially incomplete information would be a failure to investigate properly. This breaches the duty of good faith and could lead to a breach of the Insurance Contracts Act 1984, CTH, by failing to act reasonably and with due diligence. Another incorrect approach of accepting the claimant's initial statement without any verification, despite suspicious circumstances, would be a failure to exercise due care and diligence in assessing the claim, potentially exposing the insurer to fraudulent claims and contravening the insurer's obligations to its policyholders and the broader insurance market. A third incorrect approach of delaying the investigation indefinitely to gather more information than reasonably necessary would be a failure to handle the claim efficiently and fairly, potentially breaching the insurer's obligations under industry codes of conduct and ASIC guidelines regarding timely claims handling. Professionals should approach such situations by first understanding the policy terms and conditions. They should then initiate a prompt and objective investigation, gathering all relevant evidence from all parties involved. Communication with the claimant should be clear, timely, and empathetic. Decisions should be based on a comprehensive assessment of the evidence against the policy terms and relevant legal and regulatory frameworks. If there are doubts or complexities, seeking advice from senior colleagues or legal counsel is a prudent step. Question 9. Benchmark analysis indicates that the fundamental elements of a valid insurance contract are crucial for both insurers and policyholders. Consider a scenario where an applicant for a home building insurance policy fails to disclose a previous fire that occurred at the property 2 years prior, which was fully repaired. The applicant believed this information was no longer relevant as the property was fully restored. The insurer, upon discovering this omission during a subsequent claim, seeks to void the policy. Which of the following best reflects the legal standing of the insurance contract in this situation, based on Australian insurance law principles? Option A. The contract is valid and enforceable by the policyholder because the applicant answered all questions truthfully to the best of their knowledge, and the previous fire did not affect the current condition of the property. Option B. The contract is likely voidable by the insurer because the applicant breached their duty of utmost good faith by failing to disclose a material fact, even though the property was repaired and no specific question about previous fires was asked. Option C. The contract is invalid due to the applicant's intent to conceal information, irrespective of whether the undisclosed fact was material to the risk. Option D. The contract is valid because the premium was paid and accepted by the insurer, establishing a binding agreement regardless of any undisclosed historical information. The correct answer is B. The contract is likely voidable by the insurer because the applicant breached their duty of utmost good faith by failing to disclose a material fact, even though the property was repaired and no specific question about previous fires was asked. Explanation. This scenario presents a professional challenge because it requires the insurance professional to identify the fundamental elements of a valid insurance contract within a practical context, specifically concerning the disclosure of material facts. The challenge lies in distinguishing between information that is merely relevant and information that is legally material, which can significantly impact the insurer's decision to accept the risk or the terms on which it is offered. Careful judgment is required to apply the legal principles of utmost good faith and disclosure to the specific facts presented. The correct approach involves recognizing that for an insurance contract to be valid, there must be an insurable interest, disclosure of all material facts, an offer and acceptance, and the payment of a premium. In this case, the failure to disclose the previous fire at the property constitutes a breach of the duty of utmost good faith, as it is a material fact that would have influenced the insurer's assessment of the risk. Therefore, the contract may be voidable by the insurer. An incorrect approach would be to assume that, because the applicant answered all questions truthfully to the best of their knowledge, the contract is automatically valid. This fails to acknowledge the proactive duty of disclosure that rests on the applicant, irrespective of whether a specific question was asked. Another incorrect approach would be to focus solely on the payment of the premium as the primary determinant of contract validity, overlooking the foundational requirements of disclosure and insurable interest. A further incorrect approach would be to consider the applicant's intention to deceive as the sole factor, when the legal test for materiality is objective and relates to what a reasonable insurer would consider important, not just the applicant's subjective intent. Professionals should approach such situations by first identifying the core elements of a valid insurance contract as defined by relevant Australian legislation and common law principles. They should then meticulously examine the facts of the case against each of these elements. Specifically, they must assess whether all material facts were disclosed, applying the objective test of materiality. If a breach of disclosure is identified, the professional must understand the consequences, such as the insurer's right to void the contract, and advise accordingly, adhering to principles of honesty and transparency. Question 10. The control framework reveals that an underwriter is reviewing a proposal for a small business insurance policy. The applicant operates a retail store in a suburban area and has a history of minor, non-recurring claims. The underwriter has a personal, unverified perception that businesses in this particular suburban area are generally less well managed than those in other locations. considering the factors influencing underwriting decisions. Which approach best aligns with regulatory expectations and ethical best practice? Option A. Proceed with a higher premium and stricter policy terms due to the perceived higher risk associated with the suburban location, without further investigation. Option B. Decline the proposal outright, citing concerns about the general management standards in the applicant's area, without specific evidence related to this applicant. Option C. Apply the standard premium and terms for a retail store of this size, assuming the applicant's location does not inherently present a higher risk than any other similar business. Option D. Conduct a comprehensive review of the applicant's specific business operations, financial stability, and risk management practices, alongside their claims history, to determine an appropriate premium and terms based on objective risk assessment. The correct answer is A. Proceed with a higher premium and stricter policy terms due to the perceived higher risk associated with the suburban location, without further investigation. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need for accurate risk assessment with the potential for unconscious bias to influence their decision. The underwriter must apply objective underwriting principles while remaining aware of the ethical and regulatory implications of their judgment. The challenge lies in ensuring that the decision is based solely on relevant risk factors and not on personal assumptions or stereotypes. The correct approach involves a thorough review of all available, relevant information pertaining to the applicant's risk profile. This includes examining the applicant's claims history, the nature of the business, the proposed sum insured, and any specific risk mitigation measures in place. This approach aligns with the principles of fair and equitable treatment of applicants, a core tenet of insurance regulation in Australia. Specifically, it upholds the duty of utmost good faith owed by both the insurer and the insured, ensuring that decisions are made on a sound, objective basis. Regulatory guidelines, such as those issued by the Australian Prudential Regulation Authority, APRA, and the Australian Securities and Investments Commission, ASIC, emphasize the importance of transparent and non-discriminatory underwriting practices. An incorrect approach would be to make a decision based on assumptions about the applicant's industry or location, without concrete evidence of increased risk. This could lead to unfair pricing or outright refusal of cover, potentially breaching anti-discrimination laws and the principles of fair dealing. Another incorrect approach would be to rely solely on a preliminary assessment without seeking further clarification or information, which could result in an incomplete or inaccurate risk evaluation. This failure to gather sufficient information can lead to adverse selection and undermine the insurer's financial stability, impacting all policyholders. Professionals should employ a structured decision-making process that begins with clearly defining the underwriting criteria. This involves identifying all relevant risk factors and establishing objective measures for assessing them. The underwriter should then systematically gather and analyze all available information, comparing it against these criteria. If any information is ambiguous or incomplete, further investigation or clarification should be sought. Finally, the decision should be documented, clearly articulating the rationale based on the objective assessment of risk, ensuring compliance with both regulatory requirements and ethical obligations. Question 11. Market research demonstrates that a general insurance company operating in Australia is experiencing an increase in claims related to cyber incidents. To address this, the company's risk management team proposes a new strategy. Which of the following approaches best aligns with the regulatory framework and best practices for general insurance in Australia? Option A. Focus on updating the company's insurance policy wording to exclude coverage for cyber-related losses, as this is a rapidly growing area of risk. Option B. Conduct a one-off assessment of potential cyber risks and implement a set of generic IT security policies without any ongoing review or adaptation to new threats. Option C. Develop a comprehensive cyber risk register. Conduct detailed impact and likelihood assessments for various cyber scenarios. Implement enhanced cybersecurity measures and incident response plans, and establish a regular review cycle for the effectiveness of these controls and the evolving threat landscape. Option D. Implement a new firewall and intrusion detection system without formally documenting the specific cyber risks being addressed or monitoring the system's ongoing performance against defined metrics. Correct answer is C. Develop a comprehensive cyber risk register. Conduct detailed impact and likelihood assessments for various cyber scenarios. Implement enhanced cybersecurity measures and incident response plans, and establish a regular review cycle for the effectiveness of these controls and the evolving threat landscape. Explanation. Scenario analysis. This scenario presents a common challenge in insurance business fundamentals, balancing the need for efficient risk management with the imperative of regulatory compliance. The professional challenge lies in interpreting and applying the principles of the risk management process, identification, assessment, control, and monitoring, within the specific Australian regulatory framework governing general insurance. It requires understanding how these processes are not merely operational tasks, but are underpinned by legal and ethical obligations to ensure the solvency and fair treatment of policyholders. The difficulty arises from potential misinterpretations of the regulatory intent, leading to either insufficient risk mitigation or the adoption of practices that, while seemingly efficient, fall short of legal requirements. Correct approach analysis. The correct approach involves a systematic and documented process for identifying, assessing, controlling, and monitoring risks, directly aligning with the requirements of the Australian regulatory framework for general insurance, particularly as guided by APRA, Australian Prudential Regulation Authority, standards, and the Insurance Contracts Act 1984. This approach ensures that the insurer has a robust framework in place to manage its exposures, maintain solvency, and protect policyholder interests. Specifically, it necessitates a proactive identification of all material risks, a thorough assessment of their likelihood and impact, the implementation of appropriate controls to mitigate these risks to an acceptable level, and ongoing monitoring to ensure the effectiveness of these controls and to adapt to changing risk landscapes. This comprehensive and documented approach is fundamental to meeting the prudential requirements and demonstrating sound governance, which are core tenets of Australian insurance regulation. Incorrect approach is analysis, an approach that focuses solely on identifying and assessing risks without implementing or monitoring controls, is fundamentally flawed. This fails to meet the regulatory expectation of active risk mitigation. The Insurance Contracts Act 1984, while primarily focused on consumer protection and disclosure, implicitly requires insurers to manage their business prudently, which includes controlling risks that could jeopardize their ability to meet claims. A lack of control measures means that identified risks are left unaddressed, potentially leading to financial instability and a failure to fulfill contractual obligations. Another incorrect approach is to implement controls without a clear process for identifying and assessing the risks they are intended to mitigate. This is akin to treating symptoms without understanding the disease. Regulatory frameworks, such as those overseen by APRA, demand a risk-based approach. Controls must be proportionate to the identified risks. Implementing controls in a vacuum is inefficient, potentially costly, and may not address the most significant threats to the business, thereby failing to meet the spirit and letter of regulatory expectations for prudent risk management. Finally, an approach that involves identification, assessment, and control, but neglects ongoing monitoring is also deficient. The regulatory environment is dynamic, and risks evolve. Without continuous monitoring, controls can become outdated, ineffective, or even counterproductive. APRA prudential standards emphasize the importance of ongoing oversight and review of risk management frameworks to ensure their continued relevance and efficacy. A static approach to risk management fails to adapt to emerging threats and opportunities, leaving the insurer vulnerable and non-compliant with the expectation of dynamic risk oversight. Professional reasoning. Professionals in the Australian general insurance sector must adopt a holistic and integrated approach to risk management. This involves understanding that each stage of the risk management process is interdependent and crucial for regulatory compliance and business sustainability. The decision-making process should begin with a thorough understanding of the relevant Australian legislation and APRA prudential standards. When faced with a risk management scenario, professionals should ask: 1. Does this approach systematically identify all potential risks relevant to our business operations and regulatory obligations? 2. Does it adequately assess the likelihood and impact of these identified risks? 3. Are appropriate and proportionate controls being implemented to manage these risks to an acceptable level? 4. Is there a robust mechanism for continuously monitoring the effectiveness of these controls and the evolving risk environment? 5. Is the entire process documented and auditable, demonstrating compliance with regulatory expectations. By answering these questions, professionals can ensure their risk management practices are not only operationally sound, but also legally and ethically defensible within the Australian regulatory context. Question 12. Consider a scenario where an insurance company is experiencing an increase in fraudulent claims. The claims department is under pressure to meet strict turnaround times for processing claims. Which of the following approaches would best balance the need for efficient claims handling with effective fraud detection and prevention, adhering to Australian regulatory expectations for general insurance? Option A. Conduct a manual review of every single claim submitted, regardless of its value or complexity, to ensure no fraudulent claim is missed. Option B. Implement a comprehensive fraud detection system that uses data analytics to flag suspicious claims for review by experienced claims assessors, while also maintaining efficient processing for low-risk claims. Option C. Rely solely on automated flagging of claims for potential fraud, without any manual review to ensure rapid processing times. Option D. Focus fraud detection efforts exclusively on claims exceeding a predetermined high monetary value, assuming smaller claims are less likely to be fraudulent. The correct answer is B. Implement a comprehensive fraud detection system that uses data analytics to flag suspicious claims for review by experienced claims assessors, while also maintaining efficient processing for low-risk claims. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires balancing the need for efficient claims processing with the imperative to detect and prevent fraudulent activity. The pressure to meet service level agreements, SLAs, for claims turnaround times can create a temptation to overlook potential red flags, especially when dealing with a high volume of claims. Effective fraud detection requires a proactive and systematic approach, integrating various tools and human oversight, rather than relying on a single, reactive measure. The challenge lies in implementing robust fraud prevention strategies without unduly delaying legitimate claims or creating an overly burdensome process for honest policyholders. Correct approach analysis. The correct approach involves a multi-layered strategy that combines automated data analytics with human expertise. This approach is considered best professional practice because it leverages technology to identify suspicious patterns and anomalies in claims data, flagging them for further investigation. Simultaneously, it incorporates human review by experienced claims assessors who can apply their judgment, knowledge of policy terms, and understanding of common fraud schemes to assess the flagged claims. This blend of technology and human intelligence allows for a more accurate and efficient identification of fraudulent claims while minimizing the risk of delaying legitimate ones. From a regulatory and ethical standpoint, this approach aligns with the duty of care owed to policyholders and the insurer's responsibility to maintain the integrity of the insurance system. It demonstrates a commitment to fair claims handling and the responsible stewardship of premium funds, which are core principles in the Australian general insurance industry, guided by frameworks such as the Insurance Contracts Act 1984 and industry codes of conduct. Incorrect approaches analysis. Relying solely on automated flagging without human review is an incorrect approach. While automation can be efficient, it can also generate false positives, leading to unnecessary delays and potential dissatisfaction for legitimate policyholders. Furthermore, automated systems may not be sophisticated enough to detect novel or complex fraud schemes that require human intuition and experience. This approach fails to meet the professional standard of thorough investigation and could lead to reputational damage and regulatory scrutiny for failing to adequately investigate suspicious claims. Implementing a manual review process for every single claim, regardless of its complexity or value, is also an incorrect approach. This method is highly inefficient and resource-intensive, leading to significant delays in claims processing and increased operational costs. It fails to leverage the benefits of technology in identifying high-risk claims, thereby not optimizing the use of resources. Such an approach would likely lead to breaches of service-level agreements and negatively impact customer satisfaction, undermining the insurer's competitiveness. Focusing only on claims exceeding a certain monetary threshold for fraud detection is an insufficient approach. Fraudulent activities can occur across claims of varying values, and focusing solely on high-value claims may allow smaller, yet numerous, fraudulent claims to go undetected. This can lead to cumulative losses for the insurer and erode public trust in the insurance system. It represents a failure to implement a comprehensive fraud prevention strategy that addresses the full spectrum of potential risks. Professional reasoning. Professionals should adopt a risk-based approach to fraud detection and prevention. This involves understanding the types of fraud prevalent in the industry, the vulnerabilities within their own claims processes, and the potential impact of fraud. Decision-making should be guided by a framework that prioritizes efficiency, accuracy, and fairness. This includes 1. Establishing clear policies and procedures for fraud detection and reporting. 2. Investing in appropriate technology and training for staff. 3. Implementing a tiered review process that prioritizes high-risk claims for immediate human investigation. 4. Regularly reviewing and updating fraud detection strategies based on emerging trends and data analysis. 5. Fostering a culture of integrity and ethical conduct throughout the organization. Question 13. System analysis indicates that an insurance agent, incentivized by a tiered commission structure that offers significantly higher payouts for selling premium-tier policies, is advising a client seeking comprehensive home and contents insurance. The client has expressed a moderate level of risk and a preference for a balance between coverage and cost. The agent has identified 2 policies: a standard policy that adequately meets the client's stated needs and budget, and a premium policy that offers enhanced coverage beyond the client's expressed requirements, but would result in a much larger commission for the agent. Which of the following approaches best aligns with regulatory and ethical obligations in the Australian general insurance market? Option A. Recommend the standard policy without mentioning the existence of the premium policy or the agent's commission structure to avoid confusing the client. Option B. Recommend the premium policy, focusing on the potential future benefits of the enhanced coverage, and only disclose the commission structure if the client specifically asks about it. Option C. Recommend the standard policy, as it directly addresses the client's stated needs and budget, and then transparently explain the commission structure and why the standard policy is the most appropriate recommendation given the client's circumstances. Option D. Recommend the premium policy, highlighting its superior coverage, and subtly downplay the client's stated budget concerns to secure the higher commission. The correct answer is C. Recommend the standard policy, as it directly addresses the client's stated needs and budget, and then transparently explain the commission structure and why the standard policy is the most appropriate recommendation given the client's circumstances. Explanation. This scenario presents a professional challenge because it requires balancing commercial objectives with ethical obligations and regulatory compliance within the Australian general insurance market. The core dilemma lies in a potential conflict of interest where a sales incentive might influence the advice provided to a client, potentially leading to a recommendation that is not in the client's best interest. This is particularly sensitive in insurance distribution, where trust and transparency are paramount. The correct approach involves prioritizing the client's needs and ensuring that any product recommendation is suitable and appropriate for their circumstances, regardless of the incentive structure. This aligns with the principles of responsible conduct and consumer protection mandated by Australian Financial Services Regulation, including the Corporations Act 2001, CTH, and the ASIC Regulatory Guide 165, Licensing, Conducting Business Without Adequate Risk Management Systems. Specifically, it upholds the duty to act in the client's best interests and to provide financial advice that is appropriate. The incentive, while potentially motivating, must not override the fundamental obligation to act ethically and compliantly. An incorrect approach would be to prioritize the sales incentive, leading to a recommendation that, while potentially generating higher commission, may not be the most suitable or cost-effective option for the client. This could breach the duty to act in the client's best interests, potentially leading to misleading or deceptive conduct under the Australian consumer law. Furthermore, failing to disclose the incentive structure or its potential influence on the recommendation could be seen as a breach of disclosure obligations, eroding client trust and potentially contravening specific requirements under financial services legislation regarding conflicts of interest. Another incorrect approach would be to ignore the incentive altogether and make a recommendation solely based on the client's stated needs, without considering the broader range of suitable products that might be available, thereby potentially limiting the client's options and not fulfilling the advisor's duty to explore appropriate solutions. Professionals should employ a decision-making framework that begins with identifying potential conflicts of interest. This involves understanding the incentive structure and its potential impact on advice. The next step is to assess the client's needs and circumstances thoroughly. Then, evaluate all available product options against these needs, considering suitability, cost, and benefits. The decision must be justifiable based on the client's best interests, with clear documentation of the rationale. If an incentive could compromise this process, it should be managed or mitigated, potentially through disclosure or by ensuring that the incentive does not disproportionately favor certain products over others that are equally suitable. Question 14. Market research demonstrates that a significant portion of the population may have diminished legal capacity due to age or cognitive impairment. An insurance agent is processing an application for a comprehensive home insurance policy from an individual who appears to be elderly and is accompanied by a younger person who is speaking on their behalf and making all the decisions. The agent is unsure whether the elderly individual has the legal capacity to enter into this contract. Which of the following actions best reflects the appropriate professional and regulatory approach? Option A. Decline the application outright due to the perceived uncertainty regarding legal capacity without further investigation. Option B. Politely explain to the accompanying person that the insurance company requires confirmation of the elderly individual's legal capacity to enter into a contract, and suggest obtaining appropriate documentation or legal advice if necessary. Option C. Advise the accompanying person that the policy can be issued but will be contingent on the elderly individual confirming their understanding and agreement at a later date, without specifying how this confirmation will be obtained. Option D. Proceed with issuing the policy as requested, assuming the accompanying person is acting in the elderly individual's best interests and has their authority. The correct answer is D. Proceed with issuing the policy as requested, assuming the accompanying person is acting in the elderly individual's best interests and has their authority. Explanation. This scenario is professionally challenging because it requires an insurance professional to assess the legal capacity of a potential client, which is a fundamental requirement for a valid insurance contract. Misjudging legal capacity can lead to unenforceable contracts, financial losses for both the insurer and the insured, and potential regulatory breaches. Careful judgment is required to ensure that all parties entering into an insurance agreement are legally competent to do so. The correct approach involves verifying the legal capacity of the individual by seeking appropriate documentation or confirmation from a legal guardian or authorized representative if the individual appears to lack capacity. This aligns with the principles of contract law in Australia, which stipulate that parties must have the legal capacity to enter into a binding agreement. For general insurance, this means ensuring the policyholder understands the terms and obligations of the contract. Regulatory guidelines, such as those overseen by the Australian Prudential Regulation Authority, APRA, and the Australian Securities and Investments Commission, ASIC, implicitly require insurers to conduct due diligence to ensure valid contracts are formed, which includes verifying the capacity of the contracting party. Ethically, it is imperative to act in good faith and not enter into agreements with individuals who cannot legally consent or understand the implications. An incorrect approach would be to proceed with issuing the policy without addressing the apparent lack of legal capacity. This fails to uphold the legal requirement for contractual capacity and could lead to the contract being voidable. It also represents an ethical failure to act with due diligence and in the best interests of both the client and the insurer, potentially exposing the insurer to reputational damage and regulatory scrutiny for failing to adhere to sound underwriting practices. Another incorrect approach is to assume the individual has legal capacity despite observable indicators to the contrary, and to proceed with the sale without further investigation. This demonstrates a lack of professional diligence and a disregard for the foundational principles of contract law. It could result in the insurer being bound by a contract that is not legally enforceable, leading to disputes and financial complications. A further incorrect approach is to dismiss the concerns about legal capacity without any attempt to verify or seek clarification. This is a dereliction of professional duty and could lead to the insurer entering into a contract with a party who is not legally capable of doing so, thereby undermining the integrity of the insurance process. The professional decision-making process for similar situations should involve 1. Identifying potential issues. Recognize any indicators that suggest a lack of legal capacity. 2. Information gathering. seek further information or documentation to confirm or refute the initial assessment. This may involve requesting identification, speaking with a guardian, or consulting internal guidelines. 3. Consultation. If unsure, consult with supervisors, legal counsel, or compliance officers. 4. Decision and action. Based on the gathered information and consultation, make a decision regarding the individual's legal capacity and proceed accordingly, ensuring compliance with legal and ethical standards. Question 15. The evaluation methodology shows that a claims assessor has investigated a motor vehicle insurance claim where the policyholder's vehicle was damaged due to a collision with a vehicle driven by another party. Initial investigations suggest the other driver was solely at fault due to a breach of road rules. The assessor is now considering the next steps in managing the claim and recovering the costs paid to the policyholder. Which of the following actions best reflects the appropriate application of subrogation principles within the Australian General Insurance Regulatory Framework? Option A. The assessor should pay the policyholder's claim and then, after obtaining all necessary documentation and evidence of the third party's negligence, pursue recovery from the at-fault third party or their insurer. Option B. The assessor should inform the policyholder that due to the third party's fault, the insurer will not pay the claim, and the policyholder must pursue the at-fault driver directly for all damages. Option C. The assessor should proceed with paying the policyholder's claim and then initiate legal proceedings against the at-fault driver to recover the full amount paid, without further investigation into the other driver's insurance details. Option D. The assessor should pay the policyholder's claim and then absorb the cost of the claim, deciding not to pursue recovery from the at-fault driver as it is a time-consuming process. The correct answer is C. The assessor should proceed with paying the policyholder's claim and then initiate legal proceedings against the at-fault driver to recover the full amount paid, without further investigation into the other driver's insurance details. Explanation. This scenario presents a professional challenge because it requires an insurance claims assessor to navigate the principles of subrogation and recovery within the specific regulatory framework of Australian General Insurance, as governed by the Anziif Foundation Certificate in Insurance Business Fundamentals for General Insurance JIB 41-15 exam syllabus. The assessor must correctly identify the insurer's right to recover costs from a negligent third party, while adhering to ethical obligations and regulatory guidelines concerning fair claims handling and the proper application of subrogation principles. Misinterpreting or misapplying these principles can lead to financial loss for the insurer, unfair outcomes for the policyholder, and potential breaches of regulatory compliance. The correct approach involves the claims assessor diligently investigating the circumstances of the claim to identify any third-party liability. Upon confirming negligence by a third party, the assessor must then initiate the subrogation process. This means the insurer, having indemnified the policyholder, steps into the shoes of the policyholder to pursue recovery from the responsible party. This aligns with the fundamental principle of indemnity, ensuring that the policyholder is not unjustly enriched by receiving compensation from both the insurer and the negligent third party. Regulatory compliance in Australia mandates that insurers act in good faith and handle claims efficiently, which includes pursuing legitimate recovery actions to manage costs and maintain the integrity of the insurance pool. An incorrect approach would be to overlook the potential for subrogation due to a lack of diligence in investigating the cause of the loss. This failure to investigate third-party liability would mean the insurer bears the full cost of the claim unnecessarily, potentially breaching the principle of indemnity and failing to act in the best financial interests of the insurer and its policyholders. Another incorrect approach would be to pursue subrogation aggressively without sufficient evidence of third-party fault, which could lead to vexatious litigation, damage the insurer's reputation, and potentially breach regulatory requirements for fair claims handling. Furthermore, failing to communicate the subrogation process and its implications clearly to the policyholder would be an ethical failing, as policyholders have a right to understand how their claims are being managed and how their cooperation might be required. Professionals should adopt a systematic decision-making process. This involves thoroughly understanding the policy terms and conditions, meticulously investigating the cause of loss, identifying all potential parties involved, and assessing their level of responsibility. Once third-party liability is established, The assessor must then apply the principles of subrogation in accordance with Australian insurance law and regulatory guidelines, ensuring all actions are fair, reasonable, and well documented. Clear communication with the policyholder throughout this process is paramount. Question 16. The assessment process reveals that a general insurance company operating in Australia is anticipating significant operational challenges and potential customer service disruptions due to upcoming legislative changes. The company's management is concerned about the impact on its business, but is hesitant to proactively inform the Australian Securities and Investments Commission, ASIC, due to fears of increased scrutiny and potential negative perceptions. Which of the following approaches best aligns with the regulatory framework and ethical obligations for general insurers in Australia? Option A. Proactively communicate with ASIC about the anticipated legislative impacts, detailing the operational challenges and outlining the mitigation strategies being implemented to protect customer interests. Option B. Delay communication with ASIC until the legislative changes are in effect, hoping that the operational challenges will be manageable and not require regulatory intervention. Option C. Provide ASIC with a brief, high-level overview of the legislative changes without detailing specific operational challenges or potential customer impacts. Option D. Inform ASIC that the legislative changes are minor and unlikely to have a significant impact, despite internal assessments indicating otherwise. The correct answer is A. Proactively communicate with ASIC about the anticipated legislative impacts, detailing the operational challenges and outlining the mitigation strategies being implemented to protect customer interests. Explanation. This scenario presents a professional challenge because it requires an insurance professional to navigate the complex interplay between regulatory obligations and business objectives, specifically concerning the disclosure of information. The core difficulty lies in balancing the insurer's duty of utmost good faith and transparency with the potential commercial implications of revealing sensitive operational details. Careful judgment is required to ensure compliance without compromising business interests unnecessarily. The correct approach involves proactively communicating with the regulator about the potential impact of the new legislation on the insurer's operations and customer service, while also outlining the steps being taken to mitigate any negative consequences. This demonstrates a commitment to transparency and regulatory cooperation, aligning with the principles of good corporate governance and the spirit of the regulatory framework governing general insurance in Australia. Specifically, the Insurance Contracts Act 1984 CTH and the Australian Securities and Investments Commission, ASIC regulatory guides emphasize the importance of disclosure and fair treatment of consumers. By engaging with the regulator, the insurer fulfills its obligation to act with utmost good faith and to ensure that consumers are not disadvantaged by changes in legislation. This proactive stance also allows for potential dialogue and clarification, fostering a more collaborative relationship with the regulator. An incorrect approach would be to delay communication with the regulator until the legislation comes into effect. This failure to proactively inform the regulator about potential operational disruptions and their impact on customers breaches the duty of utmost good faith. It suggests a lack of transparency and could be interpreted as an attempt to conceal potential issues, leading to regulatory scrutiny and potential penalties. Furthermore, it fails to uphold the principle of consumer protection, as customers may be negatively affected without prior warning or adequate mitigation strategies being in place. Another incorrect approach would be to provide the regulator with incomplete or misleading information about the potential impacts. This directly contravenes the legal and ethical obligations of an insurer to provide accurate and truthful information to regulatory bodies. Such a failure could result in significant reputational damage, fines, and other enforcement actions by ASIC. It undermines the integrity of the regulatory process and erodes trust between the industry and its overseers. Finally, an incorrect approach would be to dismiss the legislative changes as minor and therefore not warranting detailed communication with the regulator. This demonstrates a lack of diligence and an underestimation of regulatory expectations. Even seemingly minor legislative changes can have significant implications for operational processes and customer outcomes, and a failure to assess and communicate these potential impacts is a dereliction of professional duty and a potential breach of regulatory requirements. A professional decision-making process for similar situations should involve a thorough assessment of the potential impact of any new legislation or significant business change on customers and regulatory compliance. This assessment should then inform a proactive communication strategy with the relevant regulatory bodies, ensuring transparency, accuracy, and a commitment to upholding the principles of good governance and consumer protection. Question 17. The control framework reveals that during the early days of general insurance in Australia, it was common practice for insurers to use highly technical language and obscure policy terms, often to the disadvantage of policyholders who lacked insurance expertise. A new employee, learning about this history, is tempted to suggest that this approach, while perhaps ethically questionable by today's standards, was an effective way to manage risk and limit claims in the past. They propose subtly reintroducing some of these older, more complex phrasing styles into current policy documents, arguing it reflects a historical understanding of risk management. Considering the regulatory framework and ethical guidelines for the Australian general insurance industry, which of the following represents the most appropriate response to this suggestion? Option A suggests that the employee research the historical legal precedents that supported such complex wording in the past, implying that if these precedents still hold some weight, the suggestion might be reconsidered. Option B acknowledge the historical context but firmly reject the suggestion, explaining that current consumer protection laws and ethical standards mandate clear, transparent, and accessible policy language, and that any attempt to reintroduce obscurity would be a serious breach of regulatory obligations and professional ethics. Option C agree with the employee, stating that historical practices often contained valuable lessons for risk management, and that a degree of complexity in policy wording is a necessary part of the insurance business, reflecting the intricate nature of risk. Option D advise the employee to present the suggestion to senior management as an innovative approach to policy design, framing it as a way to test the limits of current disclosure requirements while potentially reducing future claim payouts. The correct answer is B. Acknowledge the historical context but firmly reject the suggestion, explaining that current consumer protection laws and ethical standards mandate clear, transparent, and accessible policy language, and that any attempt to reintroduce obscurity would be a serious breach of regulatory obligations and professional ethics. Explanation: this scenario presents a professional challenge because it requires balancing historical understanding with current ethical obligations and regulatory compliance. The temptation to leverage historical practices without considering their modern implications can lead to significant ethical breaches and regulatory noncompliance. Careful judgment is required to ensure that past practices, even if once common, do not dictate current unprofessional conduct. The correct approach involves recognizing that while historical context is valuable for understanding the evolution of insurance, current ethical standards and regulatory frameworks, such as those governing the Australian general insurance industry, dictate professional conduct. This approach prioritizes transparency, fairness, and adherence to contemporary consumer protection laws. Specifically, it aligns with the principles of responsible conduct and the need to act in the best interests of clients, as expected under Australian financial services regulation. The historical anecdote serves as a cautionary tale, not a blueprint for action. An incorrect approach would be to justify current actions based on historical precedents, such as the historical practice of insurers withholding information or using complex jargon to their advantage. This fails to acknowledge the significant evolution of consumer protection laws and the ethical imperative for clear, honest communication. Such an approach would likely contravene provisions related to disclosure, misleading and deceptive conduct, and the duty to act with integrity, all of which are fundamental to the Australian regulatory landscape for financial services. Another incorrect approach is to dismiss the historical anecdote as irrelevant and focus solely on immediate profit motives without considering the ethical implications of past practices. While profit is a business objective, it cannot be pursued at the expense of ethical conduct or regulatory compliance. This approach ignores the lessons learned from historical abuses and the development of regulations designed to prevent their recurrence, potentially leading to reputational damage and legal repercussions. The professional decision-making process for similar situations should involve a critical evaluation of historical context against current ethical and regulatory standards. Professionals must ask themselves, Does this historical practice align with my current professional obligations in the spirit of the law? If there is a conflict, current standards must always prevail. This involves consulting relevant legislation, industry codes of conduct, and seeking advice when in doubt, ensuring that all actions are transparent, fair, and in the best interests of all stakeholders, particularly consumers. Question 18. Quality control measures reveal that a consulting firm, which provides financial advice to clients, has been operating without specific insurance coverage for claims arising from errors or omissions in the advice provided. The firm's current insurance policy only covers claims for physical injury to third parties or damage to their property occurring at their business premises. Which of the following insurance types is most critical for this consulting firm to address the identified risk? Option A, public liability insurance. Option B, product liability insurance. Option C, general business insurance. Option D, professional indemnity insurance. Correct answer is D, professional indemnity insurance. Explanation. This scenario presents a professional challenge because it requires distinguishing between different types of liability insurance and understanding their application in a real-world context, particularly concerning the scope of coverage and the potential for overlap or gaps. Careful judgment is needed to correctly identify the most appropriate insurance to address the specific risk described. The correct approach involves recognizing that the scenario describes a situation where a business's actions or omissions could lead to financial loss for a third party due to faulty advice or services. This aligns directly with the definition and purpose of professional indemnity insurance, which is designed to protect professionals against claims of negligence, errors, or omissions in the provision of their professional services. This approach is ethically and regulatorily sound, as it ensures that the business has adequate protection for risks inherent in its professional operations, thereby safeguarding both the business and its clients. Adherence to professional standards and regulatory expectations in the insurance industry mandates that businesses are appropriately insured for the risks they undertake. An incorrect approach would be to assume that public liability insurance is sufficient. Public liability insurance covers claims arising from injury to a third party or damage to their property caused by the business's operations or premises. It does not typically cover financial loss resulting from professional advice or services. Selecting this option would represent a regulatory failure by not ensuring appropriate coverage for the specific professional risks faced, potentially leaving the business exposed and failing to meet industry standards. Another incorrect approach would be to assume that product liability insurance is the primary solution. Product liability insurance covers claims arising from death, injury, or property damage caused by a defective product manufactured or supplied by the business. While a business might offer services related to products, the core risk described in the scenario is related to the advice or service itself, not a physical product defect. This would be an ethical failure as it demonstrates a lack of understanding of the insurance products and their intended application, leading to inadequate risk management. A further incorrect approach would be to suggest that no specific insurance is needed, relying solely on general business insurance. This overlooks the distinct and significant risks associated with providing professional services. It would be a significant regulatory and ethical lapse, as it fails to acknowledge the established practice and regulatory expectation for professionals to carry specific indemnity insurance to protect against claims of professional negligence. Professionals should employ a decision-making framework that begins with a thorough understanding of the client's business operations and the specific risks they face. This involves identifying the nature of potential claims, e.g., injury, property damage, financial loss due to advice, and then matching these risks to the appropriate insurance products. A key step is to consult relevant industry guidelines and regulatory requirements to ensure compliance and best practice. If there is any ambiguity, seeking clarification from senior colleagues or underwriting specialists is crucial. Question 19. Strategic planning requires an insurance underwriter to assess the legality of the purpose for which a policy is being sought. An underwriter is reviewing an application for a commercial property insurance policy for a business that operates a well-known, albeit niche service. During the review, the underwriter becomes aware through industry publications and public domain information that the primary service offered by this business is likely to be deemed illegal under current Australian state legislation, although no formal legal proceedings have been initiated against the business. What is the most appropriate course of action for the underwriter? Option A. Refuse to issue the policy, citing the potential illegality of the business's purpose as grounds for declining coverage. Option B. Seek legal advice only if and when a claim is lodged by the business to determine the validity of the policy at that time. Option C. Proceed with issuing the policy, but advise the client that coverage may be voided if their business is found to be illegal at a later date. Option D. Issue the policy as requested, as the client has not disclosed any illegal activity and the insurer cannot act on speculation. The correct answer is D. Issue the policy as requested, as the client has not disclosed any illegal activity and the insurer cannot act on speculation. Explanation. This scenario presents a professional challenge because it requires an insurance professional to identify and act upon a contract that is void from its inception due to an illegal purpose, even if the parties involved have not raised this issue. The core of the challenge lies in upholding the fundamental legal principle that contracts for illegal purposes are unenforceable, and that insurers have a responsibility not to facilitate or profit from such activities. This requires a proactive ethical and legal stance, rather than passively accepting a contract that appears to be in force. The correct approach involves refusing to issue or renew a policy where the underlying purpose is illegal. This aligns with the principle of legality of purpose, a cornerstone of contract law in Australia, which dictates that a contract's object or consideration must be lawful. Insurers are bound by the Insurance Contracts Act 1984, CTH, and general principles of contract law to ensure their policies are not used to support or indemnify illegal activities. By refusing to issue the policy, the professional is acting ethically and legally, preventing the insurer from becoming complicit in an illegal enterprise and upholding the integrity of the insurance market. This proactive stance demonstrates a commitment to responsible underwriting and adherence to regulatory expectations. An incorrect approach of issuing the policy without question fails to recognize the illegality of the purpose. This is a significant regulatory and ethical failure. It contravenes the principle of legality of purpose, potentially exposing the insurer to legal challenges and reputational damage. Furthermore, it could be seen as facilitating an illegal activity, which is contrary to the public interest and the spirit of insurance regulation. Another incorrect approach of seeking legal advice only after a claim is made is also professionally deficient. While seeking legal advice is generally prudent, delaying this until a claim arises means the insurer has already entered into an agreement with an illegal purpose. This is a reactive rather than a proactive measure and does not absolve the insurer of the initial responsibility to underwrite lawful risks. The illegality of purpose exists at the formation of the contract, not just at the point of a claim. A third incorrect approach of assuming the client is acting lawfully because they have not disclosed any illegal activity is a failure of due diligence. While insurers rely on the information provided by clients, they also have a responsibility to conduct reasonable checks and to be aware of potential red flags. In this scenario, the nature of the business itself raises a significant question about the legality of purpose, and a responsible underwriter would investigate further rather than making an assumption. This approach risks overlooking a fundamental flaw in the contract. The professional decision-making process for similar situations should involve a thorough assessment of the proposed insured activity against legal and ethical standards. This includes understanding the nature of the business or activity being insured, identifying any potential for illegal purposes, and consulting relevant legislation and internal guidelines. If there is any doubt about the legality of purpose, the professional should escalate the matter for further review and seek expert legal advice before committing the insurer to any contractual obligation. This proactive and diligent approach ensures compliance with regulatory requirements and upholds ethical standards. Question 20. Compliance review shows that an underwriter is considering an application for travel insurance from a client with a recently diagnosed chronic medical condition. The application form provides basic details of the condition, but lacks specific information regarding its severity or impact on the client's ability to travel. The underwriter is aware that the insurer's guidelines require a comprehensive assessment of pre-existing conditions before offering cover. Which of the following approaches best aligns with regulatory requirements and professional underwriting practice in Australia? Option A. Seek further information from the applicant, such as a medical report from their treating physician, to accurately assess the risk before making a decision on terms and premium. Option B. Immediately decline the application due to the presence of a pre-existing medical condition, as this represents an unknown risk. Option C. Impose a significantly higher premium and broad exclusions to cover the potential increased risk associated with the chronic condition, without further investigation. Option D. Accept the application with standard terms and premium, assuming the condition will not significantly impact the travel risk. Correct answer is B. Immediately decline the application due to the presence of a pre-existing medical condition, as this represents an unknown risk. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the insurer's need for profitability and risk management with the principles of fair treatment of customers and adherence to underwriting guidelines. The underwriter must make a judgment call based on incomplete information, where a hasty decision could lead to adverse selection or an unfair denial of cover. Careful judgment is required to ensure that the underwriting decision is both commercially sound and ethically responsible, aligning with the regulatory expectations for the insurance industry in Australia. The correct approach involves a thorough risk assessment that goes beyond the initial application data. This includes actively seeking further information from the applicant, potentially through medical reports or specialist advice, to gain a comprehensive understanding of the risk. This approach is justified by the regulatory framework governing general insurance in Australia, which emphasizes the importance of accurate risk assessment for fair pricing and appropriate policy terms. It aligns with the principles of responsible underwriting, ensuring that the insurer is not exposed to unacceptable risks, while also providing cover where appropriate and affordable. Ethical considerations also dictate that applicants should be given a fair opportunity to present their case and have their risk properly evaluated. An incorrect approach would be to immediately decline cover based solely on the applicant's pre-existing condition without further investigation. This fails to meet the regulatory expectation of a diligent risk assessment and could be seen as discriminatory if the condition does not inherently increase the risk to an unacceptable level. Another incorrect approach would be to accept the risk without any adjustment to terms or premium, despite the identified pre-existing condition. This exposes the insurer to potential losses due to adverse selection and contravenes the principle of underwriting based on the assessed risk. A third incorrect approach would be to impose an excessively high premium or restrictive terms that are not commensurate with the actual increased risk, effectively making the cover unaffordable or unusable for the applicant. This can be viewed as an unfair treatment of the customer and may not align with the insurer's duty to offer products that are appropriate for the market. Professionals should approach such situations by following a structured decision-making process. First, thoroughly understand the applicant's circumstances and the nature of the risk presented. Second, identify any information gaps and determine the most appropriate methods to obtain the necessary data. Third, evaluate the gathered information against the insurer's underwriting guidelines and risk appetite. Fourth, consider all available options, including acceptance with standard terms, acceptance with adjusted terms, e.g., higher premium exclusions or declinature, with clear justification for the chosen course of action. Finally, communicate the decision and its rationale clearly and respectfully to the applicant.